Everything you say. Yeah. What's up, folks? I unfortunately can't see how many people are in the chat when we're on YouTube, so I don't know if you guys are in the room already or not. Sometimes I'm just talking to myself while people are logging in. Unfortunately, that is one of the things that's annoying about OBS. It doesn't show you the people in the room. Like, I can't see when people log in and stuff. So maybe you guys are still logging in, maybe not. But if you're already in, let me know anything you guys want to check out. I know Obi had asked to look at pound yen, but Obi, let me know when you're in the room, and we'll go pull up pound yen. Look at it together, all right? So once you're in, pound yen, I'll pull it up already, so we're ready to go. And just let me know when you're in the chat, brother. What's up, Ed? Are there other people in the room, man? Because I can't see, unfortunately. So I want to make sure whoever asked me, are you Obi? Maybe you're Obi. I don't know. Whoever had asked me to look at pound yen, I want to go pull it up for them. Maybe I should log into my, what's up, Oscar? Maybe I should log in on my phone too, right? So I can actually see people in the room. Maybe that's something I should start doing. Well, for anybody who's new, if it's your first time with us, let me know if you have any questions about trading, if you have any tickers, any currency pairs, anything you want to check out. Just let me know in the chat, guys, and we'll check it out together, all right? I like that I get an ad for logging into my own live. Zillow and Schwab. Okay. In case I want to buy a house and open up an investment bank. There we go. Thank you, guys. Thank you. Thank you for the heads up. All right. Let's get cracking. Hopefully What's up, Jimmy? Hopefully whoever asked me for pound yen is in the room. I'm going to do my analysis. We're going to start from scratch. We'll do it together. I mean, we've already bounced off levels, but whatever. We'll start from scratch. So it's easier to see it from scratch. All right. Forex is the largest asset class in the world, guys. In Forex, you are trading currencies. So when I'm looking at pound yen, what I'm looking at is the British pound versus Japanese yen and the exchange rate. I'm basically trading and determining whether one currency will valorize or devalorize against another currency. Now, this is by far the largest market in the world. It is where banks and institutions invest the majority of their money. So it is a massive, massive market. Trades over $7 trillion a day. Huge, huge market. Great for income generation. Can also be used for wealth management. Because it is such a big market, it is more well suited towards... Yep, we're going to go through all this stuff, Ed. Well, you'll learn some of the stuff. You're not going to learn everything because that's like weeks and weeks of coursework to teach you how to do it properly. But you'll learn at least basic structure. Because it is such a big market, it is more well suited towards swing trading than it is towards day trading because of the nature of how it moves. And it does have a lot of institutional investment because it's such a big market. Biggest market where bank institutions buy and sell. So we're going to start here on the monthly time frame. And the first thing I'm looking for is institutional order flow. Where are the major banks institutions buying? Where are the major banks institutions selling? Do I have an opportunity to buy and sell together with them, right? So looking here on the monthly charts, do I have any clear institutional order flow here on the charts for pound yen? Well, I obviously have this pivot reversal. This is very easy to identify. I think anybody can see impulse in, balance, impulse out. Some big banks sold and sold heavily here, driving price action downwards explosively on pound yen. But more importantly, when they sold here, did they fill all their sell orders? Is it likely that all of their orders were filled when they sold their guys? What do you guys think? Is it likely that they filled all their sell orders when they sold there? I'm just seeing if it's a retest or not. It's not a retest. The level's up here. Sorry, this is the only downside of YouTube. There's a delay between me asking a question, you guys hearing it. I always forget about this detail. I ask questions, but it's not quite the same speed in terms of you guys hearing it and me waiting for a response. There's like a 30-second delay. Well, the answer is no. No. They did not fill all their sellers. Why are we able to say that? Because of the impulse, right? Think about what it means when price drops. For price to drop, there has to be an imbalance of more sellers and buyers driving price action down, right? Everybody with me on that? That's the only way price goes down is if there are more sellers and buyers. So for price to drop, more sellers and buyers causing that reaction in the market. So what you're seeing right here is you're seeing some big bank institution placed a large sell order. They filled some of their order, But eventually, there were no buyers left. They still had a huge pile of unfilled sell orders. And because there were more sellers than buyers, price moved down. Cool, cool, cool. Likely leaving that financial institution with unfilled orders sitting at this level. And that's just the norm for banks. They place very large orders. They're not buying 10 standard lots or 100 standard lots like you or I might. They're dealing in hundreds of thousands, millions of lots, huge, huge positions. And when you place orders of that magnitude, it takes a while to fill those orders because there's only so much liquidity available in the market. There are only so many buyers, so many sellers available. On the buy side, do we have any clear institutional order flow? I do. I have this impulse, balance, impulse. Can everyone see that continuation? Impulse in, equilibrium, impulse out. Can everyone see that? Give me a yes if you can see that visually. So here we have buyers in control. Oh, by the way, guys, if you don't mind hitting the like button, I think that helps boost us here with YouTube. So we appreciate it. If you like what we do, help give us a boost. We're trying to build up our YouTube channel because we don't have a lot of followers on YouTube. So we appreciate the help. If you like what we do, please tap and tap away or whatever, share, like, all that stuff. So more buyers and sellers driving price action up, more sellers and buyers driving price action down. And we can see we've already deeply wicked through this level, retested, popped out, retest, popped out. Like this level is super beat up on the buy side, right? Super, super beat up. Next level down from this is this beautiful continuation right here. Nice, clean level, impulse, balance, impulse. That's a nice level of institutional buying right there, driving price action up as well. So institutional buying, institutional selling, and above the institutional selling. Let's drill down to the weeklies. We always do a minimum of 3 time frames in terms of analysis, guys, because you want to get a clearer picture of what's going on. So we start on a higher time frame, then we drill down to an intermediate, and then we drill down to a lower time frame. So the first thing I want to evaluate on my intermediate time frame is I want to evaluate my trend. So looking here at the weeklies, what is my trend here on the weeklies for pound yen? Is this an uptrend? Is this a downtrend? Or is this a sideways moving trend? You guys tell me in the chat. Is this an up, down, or sideways moving trend right now on pound yen? Oh yeah, delay again. While you guys are, while the buffer is going through and sending you the message, and then you guys get the chance to respond, I'll start marking off levels in the meantime. Impulse, balance, impulse, pivot. Well, it's really a drop-based drop. Here, another impulse, balance, balance, impulse, area of institutional selling. Another area of supply right there. I'll mark that red for supply. I don't know why I marked it green. That's kind of weird. And then on the buy side, you have this pivot reversal right here, impulse, balance, impulse. But if you look, it's a retest of this pivot. So you already had institutional buying here. Not sideways. We've broken control. Why is everybody saying sideways? Am I missing something? I mean, obviously we had a downtrend, we broke control. We established an uptrend, we broke control. Whether we established something here or not, yeah, we established a little correction here, we broke that. We established a little uptrend here, we broke that. And then we have lower lows, lower highs, lower lows, lower highs. It's a downtrend. Oh, commercial popped. Why are you guys saying sideways? I'm kind of curious why you're saying sideways. Are you seeing something I'm not seeing? This looks like a very clear downtrend. Lower lows, lower highs, lower lows. Can everyone see that? I don't see anything I'm missing. All right, anyway. So what does that mean for us as traders? It means ideally we would like to go short. What's the problem with that? We're inside of demand. We're in an area of institutional buying. So not exactly the best time for us to be trying to go short, right? Either we're going to look for a counter trend trade to go long, or we're going to have to wait for price to trace back to a level of institutional selling to see an opportunity to go short. And so far, if I look at these levels, guys, how excited am I about these levels? Here's weekly demand. Some bank bought, driving price action up, leaving behind unfilled orders. Price came back in, hit the unfilled orders once, popped back up. We just came back in a second time and we're popping back up. But even if we hadn't come in, even if we were still approaching it, would I have been interested in taking this weekly long? No, right? My risk to reward ratio is garbage on it. And this is a really important part of trading, guys. Trading is not just about finding and determining what's a high probability outcome. Of course, you want to go and learn how to read charts and identify what are high probability trades. But you can't stop there. You have to take it a step further. Because no matter how good a trader you are, you're going to have winning trades and you're going to have losing trades. Because at its heart, when we do chart analysis, what are we really doing, guys? Everything we do here, all these things we mark off, all the levels, finding where banks buy, finding where banks sell, identifying order flow. Say we go through the whole 20-point scoring system, right? We have a 20-point scoring system just to evaluate the quality of a zone. Even if I go through all those steps, and let's say I get a zone that has beautiful multiple time frame correlation, good strength of movement, good in terms of range, good in terms of purity, all these factors that we look at. Let's say it scores a 20 out of 20. Is that trade a guaranteed winner because it scores a 20 out of 20? No. Doesn't matter how much analysis you do. When you're doing chart analysis, the best you can ever do in chart analysis is to determine whether a trade is a high probability trade or a low probability trade. It's never a certainty, right? There is no such thing as guarantees in trading. The best you can do is determine whether it has a high probability of moving bullish or bearish. That's it. So when we're taking trades and doing all this analysis, we're looking for the highest probability trades, but we can't stop there. We have to take it an extra step and say, okay, of these high probability trades, which ones have the lowest risk with the highest proportionate profit targets? And those are the trades we focus on taking. Because if you understand right off the bat that even if you do everything right, you still will lose trades, well, that's okay. You can accept and factor in the fact that you will have winning trades and losing trades, right? There's nothing wrong with having losing trades. It's a matter of making sure that when you lose very little, and when you win, you're maximizing your profits. And that's the real foundation of trading. Is everybody with me on that? Give me a yes if that makes sense to you. It's not losing. People lose trades all the time. Professional traders lose trades all the time. What we do is we look for trades that have low risk with high profit targets so that when we lose very little. And when we win, by taking trades that have higher proportionate profit targets, ideally 3, 4, 5 times our risk or more, like 3 to 1, 4 to 1, 5 to 1 reward to risk ratios, on those winning trades, one winning trade makes up for multiple losing trades. Everything we do, Michael, always based off order flow. Doesn't matter if you're trading stocks, options, futures, forex, crypto. Always want to look at order flow first. All right, everybody with me on that? So that's the whole foundation of it. It's not losing. Losing is part of trading. It's being good with your risk management and making sure that when you lose very little. That's trading. Being disciplined, never over leveraging, never over positioning. Most professional traders will never exceed more than 2% value at risk. So when I look at this level here, my reward to risk ratio is a 1.27 to 1 reward to risk ratio. That's not enough profit for me to be willing to take this long. Could this long go all the way up to the supply? Sure, it could. Just depends how many unfilled orders are. There is a little institutional selling here, so maybe it'll stop right here. Maybe it'll go through. I can't tell you that. I can't predict the future. But what I can tell you is it doesn't matter because I would never take that trade. It's not worth, there's not enough meat on the bone. It doesn't justify the entry, right? So it's not just about finding high probability trades. It's about finding high probability trades that have good reward to risk ratios. That's the critical aspect of it. Down to the dailies here, this is where we're looking for actual entries. So we started on our higher time frame on the monthlies. We're drilled down to the weeklies to get our intermediate structure, and now we're down to the dailies to look for actual entries. So now we are on the lower time frame looking for entries on the chart. Do I have any clear institutional order flow here on the dailies? Well, I have this beautiful pivot reversal, right? There's a nice area of institutional selling, impulse in, balance, impulse out. But there's an issue with it. What's my problem with that supply zone, guys? What don't I... Thought I'd marked it red. Did I not do it in time? Oh, there it goes. Just a nice delay. What's my problem with it, guys? What don't I like about that? Because there's two things. Well, there's two things I don't like, but there's one main thing. What's my issue with it? Who can tell me in the chat? What's your problem, Black? Why don't you like that level? Maybe it's not too bad. Let's see what this looks like. Let's see what this gives me in terms of risk to reward. Maybe there's just enough room where we can squeeze out a trade. Let's see if we can squeeze out a trade here. Down, down, down. Oh, just under. Yeah, it's the risk to reward. I'm too close to demand. So it's beautiful strength, right? Look at that beautiful strength of movement. Somebody sold and sold heavily here, driving price action down. And look at how after the first hit to this demand zone, how the second hit just broke through, right? Really, this is a retest of this, so there is a little bit of that as well. But like if you look at these levels over here of institutional buying, right? That's institutional buying right there. You can see how when price came back in and hit those unfilled orders for the first time, what happened? Popped right back up, right? More buyers and sellers, price goes up. And then you can see on that retest, we create a little bit of zone creep. New level right here, right? Price shot away, came back in, hit those unfilled orders, popped right back up. So you can see both these levels. I just want to point out to everyone, if you want to understand how professionals are looking at the market and what we're looking for, we're identifying where the bank institutions buy, we're identifying where they sell. We don't chase the initial impulse because we don't know where they're going to turn price. We instead have the patience to wait for price to come back so that we can take advantage of the unfilled orders and either buy with the banks, or if it comes back to an area of institutional selling. Can everyone see the other area of institutional selling that I haven't marked yet? That I'm about to mark off? Look at this. Impulse, balance, balance, impulse. Can everyone see that structure? There's institutional selling. And where did price turn, guys? Some banks sold heavily here, driving price action down, leaving behind unfilled sellers. So when price came back in for the first time, first hit right there, it hit those unfilled sellers, and more sellers and buyers pushed price down. So look at all of these first hits. Here's the other first hit, right? Another first hit right here. So institutional buying, driving price action up, leaving behind unfilled buy orders. Price comes back in, hits that huge pile of unfilled buy orders, more buyers and sellers, pushes price up. Institutional buying, driving price action up, we create a little bit of zone creep, comes back in, hits those unfilled buy orders, more buyers and sellers, pushes price action back up. Where does it push price action back up to? Into institutional selling. More sellers and buyers pushing price action down, leaving behind unfilled sellers. Price gets pushed back in, hits those unfilled sellers, and more sellers and buyers pushes price action back down. Look at all of those most recent first hits. Would you guys have been happy with any of those trades? Maybe. The risk to reward on this one probably wouldn't have been enough for us to take the trade. But does everyone understand the concept at least? The idea behind how we're looking for trades. Identify where the bank institutions buy and sell. Do not chase the initial imbalance caused by the banks. Instead, wait for price to retrace back to the level to then buy and sell together with the financial institutions. Cool, cool, cool. Everybody with me on that? So far, so good? So the whole point of this is, do we have anything that's actually actionable right now in pound yen? And we're not looking good, are we? Like, we're not looking like we have a lot of opportunities here on pound yen right now. This level is a retest of this and of this pivot. This pivot is a retest of this. This is a retest of that. So like every level is hit on the sell side. Let's see if the buy side gives us anything better. Because on the sell side, we're not looking pretty. I mean, even on the buy side, man, look at this. Impulse, balance, impulse. Can everyone see the difference between impulsive candles and basing candles? Can you guys see the difference between equilibrium and impulsive movement? Right? So buyers were in control, driving price action up. We had equilibrium in the market, and then buyers were in control, driving price action up again. So that's another level of institutional buying right there. And then what happened when price came back into it? Hit the unfilled buyers, pop back up. So unfortunately, brother, I don't have anything I would trade right now on this, right? Every level has been hit. You know, the 500s are fine, man. I mean, institutional numbers should always be taken into account if you're trading Forex, right? Forex and futures, it does affect both of those markets. Banks do place orders. I wouldn't necessarily say the 500 is more powerful than the 1,000. You know, they're just as equally powerful. All the major quarters are powerful levels. You know, so if you have an area of order flow that's coinciding with major order flow, then that's something that should interest you, right? Like if I look at this entry right here, right? This was the last like realistically viable trade for us on pound yen. This little demand zone, the first retracement back to this demand zone here. I think this was the last viable trade on this chart, because if you took that trade, let me just see what the risk to reward would be on it. I think you had enough meat on the bone to be able to take that long. I could be wrong, because you would have traded up to this supply, right? We hadn't formed this yet. So you would have traded up to here. And stop loss down here. Lets me grab it. There we go. Come on, man. A little more. A little more. Why? Why won't you move up a little more, dude? It seems to be stuck for some reason. I hate when it does that, dude. It's so annoying when it just randomly decides that it won't move up more. Come on. Come on, little guy. You can do it. There we go. Oh, there's something wrong here. Sorry, that's my mistake. I grabbed the wrong thing. That's not even its fault. It's my fault. Pardon me. There we go. I thought I'd drawn it on the right level, but I drew it at the bottom. There we go. It's a 3.19 to 1. So that would have been your last actionable trade, taking this long, first retracement back, multiple time frame correlation, comes back in, hits the unfilled buyers, and just pops right back up. And that would have been a day trade. You would have been in and out within the same day. Entry right here, stop us at the bottom zone, profit target right there at supply. In and out, done. Institutional numbers indicator? No, I don't need institutional number indicator, man. I understand where institutional numbers are. I don't really need an indicator for that. How can I tell it's institutional buying? Sure. So think about it from this perspective, Dylan. It goes back to, again, well, you know what it really is? It's OBS slows down things so tremendously that it's like everything's like a little laggy when I'm on OBS. Just think about it from a practical perspective, brother. Forex trades over $7 trillion a day, right? For you to cause pound yen's price to explosively impulse out of equilibrium like this, what has to happen? Well, there has to be a significant imbalance in order flow of more buyers and sellers. Does that make sense? Like that part so far, is that good with you? Price can only move if there's an imbalance of more buyers and sellers, or vice versa, more sellers and buyers. And for me to cause explosive movement out of equilibrium, there has to be a significant imbalance of more buyers and sellers. So that's part one. Now the second part is, can you or I cause that significant imbalance? If you took your entire life savings and you went long right here on pound yen at the limit price of 190.21, would it cause that reaction in the market? What do you think? Not even a little bit, right? Not even a little bit, because it requires massive amounts of capital. Does that make sense how I know that's institutional, not you or me? Like, barring some dramatic fundamentals, most major price action is driven by banks, because they're the only ones that have enough capital to place orders large enough to drive price action that significantly. You with me on that? Does that make sense? That's how. Now, do we really know? No. We're doing our best we can with chart analysis, right? I'm not sitting there in the meetings at Deutsche Bank or UBS or Bank of America and they're telling me, hey, I'm about to go long here at 190. I'm doing it based on chart structure, which is the best we can do. We're not sitting there in the meetings. But we have a very high probability indication that this is institutional and not you or me. And if it is institutional, what that means is there is a high probability of there being unfilled orders left behind, which means if price comes back to the level, now we have an opportunity to take advantage of those unfilled orders and buy with the banks. You can see it over here as well. Same exact thing. Bought heavily, driving price action up, leaving behind unfilled orders. Price came back in, hit those unfilled orders, and because there were more buyers and sellers, price went up. And that's where we're getting in. At the first retracement, we're identifying where the banks buy and sell. We're not chasing impulse. We're instead waiting for price to come back so that we can take advantage of the unfilled orders and sell with the banks or buy with the banks. Cool. Oh, volume. So you were asking me about volume before, Chillface. So you got to be very careful with volume for several reasons. One is banks will hide volume from you in dark pools, right? Because you got to think, who likes to look at volume to make trading decisions? Retail traders like looking at volume to make trading decisions. So one of the most fundamental aspects to understand about the financial markets is this. When retail traders trade in the financial markets, and you hear statistical data of 97 to 98% of retail traders lose money over time, who are they losing money to? Where is that money going? It's not disappearing, right? When you lose money, it's just transferring to someone else. So who's it going to? Well, it's going primarily to whomever is on the other side of the trade, and typically that will be the banks and financial institutions. A huge proportion of the profits that banks make in the financial markets are off of retail traders. So they're not like passively trading alongside you, they are actively trading against you. And the reason this matters is if your level of knowledge is limited to basic concepts of technical analysis, and using volume profile, things of that nature is a very basic concept, right? Like imagine for anybody, remember the first time you ever heard about like OI or level 2 data or volume profile? Like what was your thought the first time? Like what, I can see where there are a bunch of orders sitting? What was your thought when you heard that for the first time? You're probably like, oh my God, this is going to make my trading so much easier. This is the secret to trading. I have found the holy grail of trading. My goodness, I can't believe this information is so incredibly valuable, right? Isn't that the way most people think of that when they first hear about it? They're excited about it. I know I was. No. I mean, different levels, but still concept is the same. And that was the way I thought about it when I first heard about it. So now, think about it from the bank's perspective. Banks make the majority of their profit off of retail traders. They are actively trading against them. If almost every retail trader trades in the same manner, right, which is usually going over to this place that we're in right now and watching videos on basic concepts of technical analysis, right? Support, resistance, Bollinger Bands, Elliott Waves, moving averages, stochastics, RSI, Fibonacci retracements, volume, MACDs, VWAP, candlestick patterns, Ichimoku clouds, the fair value gap garbage, all this generic, basic entry-level kiddie stuff, right? All what I call the kindergarten trading. And so they learn a lot of things about kindergarten, right? They're like, oh, this nap time thing is interesting. Oh, I love recess. What? Snacks? Oh, kindergarten's the best. But because they spend all this time in kindergarten, they'll spend days, weeks, months, sometimes years in kindergarten studying kindergarten level knowledge, they'll think because they've dedicated a lot of effort to it that they now have master's degrees. But do they have master's degrees? No, they're barely scratching the surface of entry level analysis. Right? Barely scratching the surface. And using volume profile as a decision-making factor is a very risky proposition because banks are aware that retail traders try and use volume as a decision-making factor, and they will oftentimes hide volume from you with that in mind. They will also sometimes leave orders that they will pull on things like level 2 or I to entice you towards certain levels to trap you out. Right? Has anybody ever seen that before? Like you go and you look at OI and you're like, man, there's a lot of orders sitting at this price point, and then when price comes to that level, it just blows right through the level. Who's ever seen that happen? Happens all the time, right? Because banks are savvy. They're not dumb. They're smart. They're smart and they understand how retail traders trade, and they will actively trap you out at certain levels if you're trading in the obvious levels. So it's not to say that volume is bad. It's not to say that OI is bad. It's not to say the level 2 data is bad. It's just that you should use it as a confirmation, not as a decision-making factor. Does that make sense? So if you're in a major level of institutional order flow and there happens to be a lot of volume, or there happens to be a lot of level 2 limit orders or whatever, cool. It's an extra check mark next to your trade. But if it's not there, that shouldn't be something where like, oh, then I shouldn't take the trade. Or if you don't have good institutional order flow and there is this huge level of volume, that shouldn't be a decision-making factor either, because it's very secondary, right? It's just a secondary confirmation at best. Does that make sense? Like we can look at it here on this chart. Would we have been interested in this long position here? We would have been interested in this long. If I go and I don't know if there's going to be volume or not. We'll find out if it lets me. There we go. Volume. I'm sure they have a volume indicator here somewhere. There we go, volume. Okay, so when we came back in, there was a spike, but did the spike happen after it already impulsed out? Probably, right? It was after we started having the impulse move that people started buying in, chasing the price action. Right? So if I waited for this close, would I have been entering at the right point? Like let's say I said, ooh, we just had this nice bullish candle close, fantastic, lots of volume, and then I decided to buy. Would that have been a good moment for me to buy? Does that make sense what I'm talking about in terms of waiting for volume confirmation? You would have been screwed, right? You would have ended up buying right into institutional selling. Is everybody with me on that? Does that make sense? That's why like using this as a decision-making factor is a very risky proposition. Because a lot of times you're going to be late to the move. Cool. So just things to be cognizant of. All right, guys, I'm going to go hop and eat some dinner, or not some dinner, some lunch. Buy low, sell high is definitely better. If anybody would like to learn more about this, free workshop Thursday night, 7 p.m. Eastern. If you have a chance and you want to learn more about trading, come to the free workshop. We'll teach you more about it. You can register right on our website, TradePhantoms.com. Just click this purple register here button. And in that workshop, we'll do a deeper dive in all these topics, guys. We'll teach you more about how the markets really work, how we identify institutional order flow, where the major banks and institutions are buying and selling so we can buy and sell together with the banks. This is the foundation of how professionals trade. How to trade in all market conditions, whether the market is bullish, bearish, or consolidating. How to use leverage properly so you can reduce your risk and generate higher rates of return. The difference between all the different asset classes, stocks, options, futures, forex, crypto, what they're best suited for, and trading for income versus wealth management. So we'll teach you a lot more about it. It's free, it's fun, it costs you nothing but some of your time. And if you're interested in becoming a Trade Phantoms Pro member, if you want us to actually teach you and mentor you and trade live with you, we even provide you with trades that we ourselves take in the market, you will have a special opportunity to enroll at a discounted rate if that's something you want to pursue. Because we have that special